three big dials that they report financial results on. So think about this as a dial in a financial cockpit. This is in a financial cockpit. You're going to fly your plane, you need these three dials. The first dial that accountants have is called things and stuff. So all businesses have things and stuff. And the things and stuff in a business are things and stuff like cash, like accounts receivable, which is money owed to you by your customers. It's things and stuff like inventory. Inventory, some countries call it stock. We're going to call it inventory. This is stuff that you buy that you're going to turn around and resell. So if I owned a women's dress shop, when I bought dresses to put on the showroom floor, it's inventory until I sell it. When I sell it, it becomes a cost of goods sold. I'm going to say it again. If I own a women's dress shop, the dresses that I buy that put in the shop, I'm buying the dresses from the manufacturer, I put them in my shop. While they're in my shop, they're inventory. And when I sell them, it becomes cost of goods sold. So inventory is things and stuff. Not all businesses, by the way, have inventory. In fact, in today's economy, the vast majority of businesses do not have inventory. That's okay. You just have a little bit less complicated plane to fly. If you got inventory, it's a little more complicated to fly your plane. But if you don't have inventory, it doesn't mean you don't need this piece of paper. It just means, okay, it's kind of simpler. So every business has things and stuff, cash, accounts receivable, inventory, and there's something called property, plant, and equipment. Fixed assets. Property, plant, and equipment. These are things like buildings and vehicles and computers and machinery. This is stuff in your business. And not every business in today's economy's got a lot of property, plant, and equipment. There's a lot of businesses that have relatively modest property, plant, and equipment, and they do very, very well. So none of these are a requirement. It's not good or bad if you have them. It's just all things and stuff. Now check this out. We either owe or we own our things and stuff. Businesses have things and stuff, and as business owners, our businesses either owe on our things and stuff, or the business owns its things and stuff. A business might owe on accounts payable. That's money that you owe, maybe the trade, maybe a credit card. This is money that the business has received the service but hadn't paid for it yet. That's accounts payable. Maybe there's notes payable. Notes payable would be like money that's owed to a financial institution or a bank. Money that's owed to, maybe the money is owed to one of the shareholders, but it's money that's owed long term. Accounts payable are short term, notes payable tend to be long term. And then finally, one other kind of note is taxes payable. So it could be that the business owes money to the government for some kind of taxes. But these are the three main O-W-E. These are the three main owing accounts. Accounts payable, taxes payable, notes payable. So a business has things and stuff, and it either owes or it owns its things and stuff. A business owns two things. A business owns two things. A business owns the investment that was made by the founder or the shareholders or the PE group or the venture capital group. A business owns the investment, and a business owns its earnings. A business owns its profits. And at the end of a year, a business can choose, stay with me, a business can choose to either distribute the earnings to the shareholders, because they own them. A business may say, we're not going to keep the earnings. We're going to distribute the earnings to the shareholders, which is called a dividend. A dividend is simply a business saying, no, we're not going to keep the earnings. We're going to distribute the earnings to the shareholders. A business might pay a dividend, or a business may say, no, we're going to keep those earnings. We're going to retain those earnings in the business. And so when you look at this piece of paper from your accountant, you'll often see the word retained earnings. Retained earnings. Well, it's just earnings that the business has made that the business decided to keep instead of distribute in the form of a dividend to its shareholders. Nod your head. Nod your head. You're with me, right? All right, good. Watch this. Accountants are very clever people. Accountants have said, look, things and stuff equals what you owe plus what you own. In other words, the left-hand side of this piece of paper always equals the right-hand side. The left-hand side equals the right-hand side. Things and stuff equals what you owe plus what you own. You already know this. If I put this in accounting terms, accountants, unfortunately, don't talk about things and stuff. They talk about assets. That's what an asset is. An asset is just things and stuff. Accountants don't talk about how much you owe. They call this a liability. A liability is simply money you owe. You only owe money 3 places: accounts payable, notes payable, taxes payable. How hard is this? And then on own, they don't call that own, they call that equity. So equity is what the business owns, and a business only owns 2 things. It owns the investment that was made by the shareholder, and the business owns its earnings. And the left-hand side equals the right-hand side. Now check this out. Are you with me on this?
Yeah.
Hello? All right. Check this out. Check this out. If I showed you this piece of paper right here, and I said, assets are 100, liabilities are 60, how much is the own?
40.
Oh my, y'all are really good. If whatever you're doing doesn't work out for you, consider accounting. Y'all are like naturals. This is unbelievable. Everybody in this room said, okay, if you have 100 of things and stuff and you owe 60, then you must own 40. So assets equals liabilities plus equity. Things and stuff equals what you owe plus what you own. The left-hand side always equals the right-hand side. Hello? Okay. So, check this out. This piece of paper right here, because accountants are so clever, is called a balance sheet. A balance sheet, because it's always perfectly in balance. The left-hand side equals the right-hand side. Not only is it always perfectly in balance, this particular dial is unlike the other 2 dials that accountants have. This dial, called a balance sheet, unlike the other 2, this dial is a snapshot. It is a moment in time. It will almost always say up here at the top, as of a certain date, as of December 31st, 2016, as of June 30th, 2017, as of November 30th, 2015. It's always as of a date. It's a snapshot. It's the way it looks right now. Right now, this instant, that's the way it looks. And the way it looks is we're going to keep track of things and stuff, cash, accounts receivable, inventory, property, plant, and equipment, what we owe, accounts payable, notes payable, taxes payable, and what we own. We own the investment and we own the earnings. And every single balance sheet has these three boxes. Every single one. This is dial number one that accountants have. And you're way down the road to speaking the language. Here comes dial number two. Accountants have a piece of paper that we're going to draw like this. This piece of paper is going to keep track of sales or revenue. In some country, it's called turnover. Same thing. Sales minus expenses. In other words, how much did it cost? Listen to my words. Expenses. How much did it cost to produce or attract the revenue? How much did it cost to produce, fulfill, attract this revenue? Sales minus expenses equals profit. Sales minus expenses equals net income. Sales minus expenses equals earnings. Earnings. Sales minus expenses equals the bottom line. So when you hear people talk about the bottom line, what they're talking about is, okay, this business had 10 of sales and it had 6 of expenses, and therefore it had a $4 profit. Now I might show you another business that had 1,000 in revenue and 996 in expenses and 4 in profit. They got the exact same profit, but are they the exact same business?
No.
Hello?
No.
No. These are not the same business. Two entirely different businesses, but they got the exact same bottom line profit. This is the number that every single one of us, the first thing we do, every time we look at our financial statements, we turn to this page in our financial stuff that we get from accountants, and we look right here at this number, and if this is, we obsess about the bottom line profit. And if it's a good number, we'll have a drink. If it's a bad number, we'll have 2 drinks. We're drinking about and obsessing about this number, and yet here I got a business that had 10 and 6 and 4. Here I got a business with 1,996, and it's also got 4. This guy's probably having 1 drink. This guy's probably having 100. And yet they got the exact same bottom line. This number right here is simply the result of some math that happened up here. If I'm going to obsess about something, I need to be obsessing about how much is my revenue and how much of my revenue is being consumed by my expenses, because for every dollar I can shave off of this number right here, the expenses, I add $1 to the bottom line. Every single dollar. And most of us aren't measuring this up here. We're spending all our time drinking over down here. It's unbelievable. This particular scorecard, accountants have got 50 names for it, but I'm going to call it an income statement. An income statement, a P&L, a statement of operations, all of them are the same thing. It's an income statement. It basically says how much is your revenue, how much is your expenses, how much is your bottom line profit and your earnings. Now check this out. This piece of paper is a movie. It's a movie. It's not a snapshot. This piece of paper is for the month of June, for the 3rd quarter, for the year 2017. It's for the entire time period, whereas a balance sheet is a snapshot of a moment in time. This is for the entire time period. This piece of paper is a movie. Hear me now, believe me tomorrow. Hear me now, believe me later. This piece of paper is a theory. It's a theory. All this drinking we're doing is about a theory. I'm going to say this a different way. You can't spend your profits. Hear me now. Believe me tomorrow. You cannot spend your profits. You can only spend cash. This piece of paper is not cash. This piece of paper is the theory of how much revenue did we have, because not all our customers paid us in cash. A couple of them gave us an IOU. How much were our expenses to service or attract that revenue? We didn't pay all of our bills in cash this month. Some of them, we owe some people some money. So in theory, if I collect all the money that's owed to me and I pay all the people I owe, here's how much is left over, in theory. But if one of these people that I sold some stuff to decides not to pay me, or I decide not to pay some of the people I bought some stuff from that I haven't paid yet, this number is going to change. It's a very important theory. Income statement is a critical piece of paper because it tells you a lot about your business model. It tells you a ton about your business model. How's your business doing from a health perspective? In theory, this is how it's doing. So this piece of paper is an income statement. It's a movie and it's a theory. There's one more piece of paper. One more piece of paper. It looks like this. One more dial in the accountant's report cards. Accountant's report cards, one more dial, it looks like this. This piece of paper is designed to keep track of cash. So it's a statement of cash flow, a cash flow statement. So I'm just going to say cash statement. That's what this is. And it's designed to keep track of cash. You'll notice there's 3 boxes, which means there's 3 different kinds of cash. Cash can be generated or used from 3 different places. Cash can be generated or used from 3 different places. There's operating cash. That's called O cash. O cash is operating cash. This is money that's generated by making a sale. This is money that's used when you pay the light bill or pay your employees. This is money that's generated or consumed in the actual operations of the business. There's a different kind of cash, which we're going to keep track of. It's called iCash. So operating, iCash stands for investing. There's a different kind of cash. Investing cash is when you buy some more shit or you sell some of your shit. So if you buy a new vehicle, that consumes investing cash. And when you sell a piece of machinery or a piece of real estate, that generates investing cash. But that's not your business is not based on buying and selling machinery and computers and vehicles. Your business is whatever you do. So you just took one of your assets and you either sold it or you bought another one. And if you buy another asset, then that consumes cash. And if you sell one of your assets, that generates cash. So there's investing cash. Cash can be generated by operations, by investing, and finally F-cash. F-cash is financing cash. Financing cash. Financing cash can be generated when you borrow money from the bank. Or if you go to your shareholders and say, okay, everybody put in another $10,000. That's financing cash. If you repay the bank or you pay a dividend, that consumes financing cash. So financing cash is very different than investing cash, which is very different from operating cash. Operating cash is from the operations of the business. Investing cash is from buying and selling assets. Financing cash is from borrowing or repaying a financial institution. 3 different kinds of cash. Now here it comes. This is the key to the whole deal. Let me say this first, before I tell you the key to the whole deal. This is a movie This is a movie, just like an income statement. This is a movie. It's what happened over time, what happened over the month or the quarter or the year. This is a movie, and a statement of cash flow is a fact. It's a fact. This is real. You can spend this. Now watch this. Accountants got this figured out. Watch this. If you look at a balance sheet, what you're going to see right up here at the very top, what's the very top thing? Not things and stuff. What's the first thing under things and stuff? Cash. This is cash right here. And if you look way down here, and this is in the upper left-hand corner and the lower right-hand corner, way down here at the very, very bottom, what is this right here? Earnings, profits. Earnings are not the same as cash. Accountants got these two things as far apart as they possibly can get them so that you don't get confused, that you can spend your profits. So here you are obsessing about the profitability of your business and under the mistaken and misguided belief that your profits are the same as cash, which is why you get to the end of the month, you get to the end of the quarter, you get to the end of the year, it's time to make payroll, it's time to make the note payment, you get the call from your accountant that says you owe all this money in taxes, and you go, where's my cash? They're two different things. You can make a profit and not have any cash. You can not have any cash and make a huge profit. Let me ask you a question. Is it possible for a company that's profitable to go broke? Hello? Yes. It happens all the time. All the time. Businesses that are profitable go broke. Why does a business go broke? They run out of cash. They can't pay their bills. You know that you're broke when you are out of cash and can't borrow more. That's when you're done. Could you have $1 million in cash and have no profits? Hello? Yeah. Yes. Could you have $1 million of profits and no cash? Of course. They don't have anything to do with each other. But we've gotten all consumed about this idea that let's obsess over an income statement. All right, here it comes. Here it comes. This is the whole deal right here. Here's a balance sheet. Here's an income statement. Here's a statement of cash flow. Balance sheet, things and stuff, owe. Left-hand side equals the right-hand side. Things and stuff equals what you owe plus what you owe. It's a snapshot. Income statement. Sales minus expenses equals profits, equals earnings, equals net income, equals the bottom line. This piece of paper is designed to keep track only of revenue, not cash, revenue and cost of servicing or generating that revenue. This is a movie and it's a theory. Third piece of paper accountants have. Third dial. A statement of cash. 3 different kinds of cash. O, I, F. Operating, investing, financing. Cash can be generated or used from any one of these 3. One of these 3 is the big monkey in the jungle. One of these 3 is the whole reason to be in business. It's not this number. It's one of these 3. It's one. I'm not going to tell you which one. It's one of these 3 is the whole reason to be in business. What we want to do as owners is convert our assets into revenue. Our revenue into profits, our profits into cash. Why else do you have assets? that we require assets to generate revenue. Generate or service our revenue. The only reason I want assets is so I can get some revenue. And sometimes, if we're an asset-light business, then the definition of assets is not what's on our balance sheet. Maybe the definition of assets is number of employees. How many employees does it take to generate $1 worth of revenue? Once I have, how many employees does it take? That's not going to be on the balance sheet. That might be the definition, an alternative definition of assets. How many assets does it take to generate $1 worth of revenue? For every $1 worth of revenue, how much of that is converted into profits? And for every dollar I generate in profits, how am I doing at generating $1 worth of cash? And here's what's happened to most of us, candidly. This number right here is chubby. We got too many employees, too many assets. We pimped our shit. So we got too much shit, so we're bloated. This number right here is chubby. It's not being as effective as it possibly could be at generating revenue. Our revenue is not getting converted efficiently into profits because we have bloated expenses right here. They're bloated. So we generate $1 worth of revenue. We work our ass off to get $1 worth of revenue, and then come down here, and this number right here is anemic, and we don't ever bother to look at these two numbers up here that caused it. We're just sitting around getting drunk over the bottom line. It's stupid. And then our job is to take this profit and convert it into operating cash, and if you come back tomorrow, I'll tell you how to do it. All right, now check this out. Just check this out. Here it comes. Are you guys with me? I got a balance sheet. A balance sheet has how many parts? Three. The left-hand side is called things and stuff. Right here it's called how much you. This is called how much you. Is a balance sheet a snapshot or a movie? You're exactly right. Here's the second dial right here. This piece of paper is called an income statement. It's divided into two parts. In the upper part right here, we're going to keep track of revenue or sales minus expenses equals, is this piece of paper a snapshot or a movie? It's a movie. Is it a theory or a fact? Theory. Here's the third piece of paper. Third piece of paper looks like this. This is a statement of cash. This has got three different kinds of cash. There's three different places cash can come from or go to. The first one is called, the second one is called, the third one is called. Is this a movie or a snapshot? Is it a theory or a fact? On a balance sheet, there's something called earnings. It turns out it's the exact same number. This number right here on an income statement is exactly the same as this number right here on a balance sheet. If you see the number 10, if you see the number 10 right here on your balance sheet, all you got to do is say, I wonder how I got to the number 10. You look over at the income statement, it says, Keith, here's how you did it. You had 45 of revenue, and you had all these expenses that added up to 35. And so when you take 45 of revenue minus 35 expenses, you get 10. In other words, a balance sheet is a world atlas. And an income statement is a street map. This tells you exactly how you did it. This gives you, the balance sheet just gives you a big picture. Now, watch this. Watch this. On a statement of cash, at the very bottom, down here, there's something called ending cash. So a statement of cash flow, the cash flow of a business is the amount of cash generated and used during that time period in O, I, or F. If you start with beginning cash and you add and subtract all of the cash flows, you'll come up with ending cash. Ending cash on a statement of cash flow. On a balance sheet, up here in the upper left-hand corner, there's something called cash. It turns out it's the exact same number. It's the exact same number. So you look at a balance sheet and you say, I got 2 of cash. What happened to all my cash? So you look at the street map, and the street map says, all right, here's how you did it. You started with this much, and then you had cash flow from operations, like cash flow from investing, cash flow from financing, add all that together. Bottom line, dude, you got 2. It's the same number. This is how they fit together. Now here's what I know. I know that some of your notes are a little messy, and so I'm going to do this for you. Check this out. Help me out here. Help me out, right? So I don't have no clicker. Is this one working? It'll work. Here's the balance sheet. Things and stuff. What I owe. What I own. Oh, not yet, not yet. Don't take a picture yet. This piece of paper is a snapshot. Now you can take a picture. Okay, fine. Okay. All right, so this is the balance sheet. Here comes an income statement. Here comes an income statement. Income statement's got sales and expenses. You take sales minus the expenses equals bottom line earnings, profits, net income. This particular piece of paper is a movie or a snapshot? It's a movie. This is what happened over a month, a quarter, or a year. Is this a theory or a fact? It's a theory. You're exactly right. Okay, we're about to go. Here comes the third one. The third dial that accountants have that ought to be in your cockpit if you want to avoid crashing your business. The third dial that you need to be looking at is a statement of cash flow. Because you can't spend your profits, you can only spend cash. You know that. If I told you to leave here tonight, take your balance sheet to the fanciest, most expensive restaurant here in Palm Beach. Don't take your billfold, don't take your purse, don't take a credit card, don't take any cash, don't take any checks, take your balance sheet. You walk in, order the most expensive meal, your biggest bottle of wine, do the whole thing. And when the check comes, go, oh, I don't have any money, but I do have some retained earnings. So you try to pay for your bills with your retained earnings, you're going to be washing dishes. That's what happens to most of us. We think that our earnings are real. So this is a statement of cash flow. 3 different kinds of cash. Operating cash, investing cash, financing cash. Now watch this, watch this. If I have operating, investing, and financing cash and ending cash, my cash flow is the amount of cash, the operations, the investing, and the financing produced in that time period. So if it's a month, where did my cash, if I look at my beginning cash and my ending cash, where did that cash come from? Where's it going to? Well, it's only coming from or going to one of 3 places. Operating, investing, financing. This is a movie. This is a movie. And is this a theory or a fact? It's a fact. You're exactly right. Okay, so here we go. Here's how they tie together. I got a balance sheet. I got an income statement. I got a statement of cash flow. It turns out that on an income statement, there's such a thing as earnings. On a balance sheet, there's such a thing as earnings. It turns out it's the exact same number. It's the exact same number. On a statement of cash flow, there's such a thing as ending cash. On a balance sheet, there's such a thing as cash. It's a snapshot. This is how much cash you have. It turns out they're the exact same number. So I got a balance sheet that is a world atlas, and I got 2 street maps. These street maps are designed to give me the particulars about how we got from where we were to where we are now. And I got to have all 3 dials in order to have optics. Now, tomorrow, one of the things we're going to talk about is, okay, so you got all these optics. How do you know what to do differently in the future so that you can have different results?
Thank you.
I got to know what activities I need to change in order to produce different results. Remember what I told you. Management makes decisions. Decisions get converted into activities. Activities get converted into numbers. Accountants are really, really good at converting activities into numbers. That's how they get their report cards. That's a balance sheet, an income statement, and a statement of cash flow. It's critical that we have these. The key, though, is how do we look at these? How do we analyze these? How do we think about these? What should we do different in the future? In other words, based on the numbers I get from my accountants, what activities should I change going forward so I wind up with better optics? I wind up with a treasure map that actually has an X on it. Now here's the truth. Here's the truth. You know it and I know it. Neither one of us care about any of those 3 pieces of paper. Our accountants love them. We don't care. Here's what we care about. What we care about is how do I plug the profit leaks in my business? How do I maximize the cash flow that this business produces? How do I increase my returns or anticipate crisis or spot danger signals, optimize performance, drive results, maximize enterprise value? How do I do that? Well, these outcomes that you're seeing on the right-hand side of your page, those outcomes are a result of having 3 pieces of paper from your accountants. Balance sheets, income statements, and statements of cash flow. And the information is embedded in those 3 pieces of paper, but you gotta know what to look for. You gotta know, and you don't know how to look for it until you learn the language, and that's what you did tonight.